So I just want to give my thoughts on the inverted yield curve, or rather the yield curve becoming even more inverted today, this morning, than it has in a very, very long time, I think 12 years. And that's because there's really a lot of misinformation out there, whether it's from Alan Greenspan or Janet Yellen. Maybe they were even asked to come and give misinformation. And I'll talk about that in a second. So if you're not familiar with the inverted yield curve and what happened, so I covered this earlier this year, I think in May, that the spread between the 3-month and the 10-year yields had been inverted since May. And I looked through, I want to say, around 7 articles and research reports, including like a 5 or 10 page academic research report back at the time. This was April and May when the yield curve was getting dicey then. And the research I saw back then was, it was going back through financial history, that basically, even though an inverted yield curve was a leading economic indicator of a recession, it often lagged. So what that means then is that it doesn't immediately guarantee an official recession, but that it is a very good predictor for a recession. So it has a very high predictive rate of a recession. And now today, the spread between the 10-year and the 2-year yields, the spread now is inverted, which is has not happened in 12 years, first time in 12 years. So the 2-year, 10-year spread has collapsed into inversion. And also, the 30-year yield on the 30-year US Treasury drops to an all-time low. So the 30-year is now, let me pull up. Actually, I have the 10-year. The 10-year is down a lot too. The 10-year is down to 1.58. So in October of last year, the 10-year was at 10-year US Treasury yield was at 2.78%. We're all the way back down to 1.58. So this is the normal type of behavior where the global economy, a lot of investors all over the globe, money is, if you look at the tape, the market action, a lot of money is coming into the US bond market. So whether that money is leaving stocks, foreign stocks or American stocks, or oil or other assets, that capital is going into what is viewed as, at least in the past, as safe havens. Can traders manipulate it? Yeah, it can be manipulated, but this looks like this is what the people in power want. They want lower yields. I've talked about this for a long time now. The US federal government cannot afford to pay a high interest rate because of the total debt outstanding. So lower yields on these bonds, it means that the US government can issue, and the US is going to have to issue a lot of bonds soon. They're going to be able to issue bonds at lower yields, and there will be demand for them. It might be suckers. It might be some pension funds, who I don't think are, a lot of pension fund managers are exactly the smartest guys in the room, or the boards of pension funds who don't want to pay competent people to manage their money. They'd rather get raped and pillaged by Wall Street, hedge funds and Wall Street investment banks and private equity. They'd rather get raped and pillaged with bad investments and get fleeced for tens of millions of dollars per year in fees instead. Why did the Dow drop today? I think a lot of this, with the yield curve, with capital coming into U.S. bond markets, I think it all started last night with the China economic data. Okay? That the global economy, and then you had the German economic data. So you had the China economic data. It was bad. So the numbers that were released by the National Bureau of Statistics, if they're saying it was bad, the real numbers are probably much worse. And I'm sure a lot of people are thinking the same thing, because I speak to a lot of financial professionals, and what most of them tell me is that they think that the Chinese economic data is even more fraudulent than pretty much every other country. On top of that, you had the stuff in Hong Kong. If you are on Twitter, you have almost definitely seen the videos going around from the People's Liberation Army, even the China's own, I think one of the China Global Times or one of their propaganda media outlets was posting the video of the military gathering outside Shenzhen. So you see these things. You see really bad economic data out of China, and you think that number is probably nowhere near as good. You think that number is drastically overestimating how good that number is being way too optimistic about and the real number is much worse. By the way, props to the very brave Chinese economist from mainland China who came out in December of 2018 with his calculations that China's real GDP was 1.67% and was contracting violently, and he predicted a very bad 2019. And I hope the guy's all right, because there is no free speech in China. I heard he disappeared for 3 months, which meant he went to a re-education camp, so hopefully the guy's all right. Hopefully he's okay now. But you can't tell the truth like that. So, this yield curve, it's normally an excellent predictor of an eventual official recession. The research that I looked into in May said normally there was about an 18 to 34 month lag between the yield curve going inverted, staying inverted for a while, and then eventually an official recession. But there's other articles where Zero Hedge is quoting other investment bank analysts and other researchers saying that it could be between, I think, 8 and... One of them here says, I think 8 months, as soon as 8 months. But the main reason, besides talking about the yield curve and talking about how it's even more inverted now, the main reason I wanted to do this short little update is now today you have Alan Greenspan and Janet Yellen, and this reminds me a lot of the Kevin Bacon character from Animal House. So remember, I did a show a couple weeks ago where it was called Panic, Confusion, Chaos, and Desperation at the Fed, and Kevin Bacon is like, if you're familiar with that movie Animal House, and there's no way that movie would have been made anymore, but Kevin Bacon is in like a military uniform when towards the end of the movie, I think the last like act of the movie, and all these people, it's like a Chinese fire drill, and all these people are running away, in pandemonium away, and you know, he's by himself, he's screaming, "Remain calm, all is well, all is well." You know, he's just like, he's like shaking and he's angry no one's listening to him, and then I think he gets trampled. So, and that's how I view what Alan Greenspan and Janet Yellen are doing. Janet Yellen said today that a yield curve inversion may be a false recession signal this time. Okay, let's read what she says. Quote, "Historically, the yield curve inversion has been a pretty good signal of recession, and I think that's when markets pay attention to it, but I would really urge that on this occasion, it may be a less good signal," end quote, Yellen said on Fox Business Network. Why is she ignoring history? Why is this time different, Miss Yellen? And then Alan Greenspan, oh God, I don't even know if Alan Greenspan's coherent at this point. He has been talking for the last couple years about stagflation, so he's at least been honest about that. He claims that he owns a lot of gold now, so I don't know if he's telling the truth or not, but he has been talking about how he expects a lot worse stagflation. He just said zero interest rates and negative yields have no meaning. He said, quote, "Zero has no meaning." Negative yields are, quote, "no big deal." Okay, let me read this whole quote. Former Federal Reserve Chairman Alan Greenspan says he wouldn't be surprised if U.S. bond yields turn negative, and if they do, it's not that big of a deal. Quote, "There is international arbitrage going on in the bond market that is helping drive long-term treasury yields lower," end quote, Greenspan, who led the central bank from 1987 to 2006, said in a phone interview. Quote, "There is no barrier for U.S. treasury yields going below zero. Zero has no meaning besides being a certain level," end quote. So, to a certain extent, he's kind of right about there being some arbitrage, but a lot of professional bond managers, they can't hold cash. Remember, I explained this to you a lot lately, that the professional bond managers can't hold cash, so they're looking at relative yields, and they're seeing that U.S. still has positive yields, and that's why a lot more capital is coming here. So if you're a professional bond manager and you have to buy bonds, and you can't hold a lot of cash, maybe you can hold 10% cash, and you have to buy some type of bonds, and you're allowed to buy bonds in different countries, you're going to buy the U.S. bonds. Those are going to be the preferential ones because at least they have a positive yield. So that is part of the reason why there's a lot of capital coming into the U.S., into bonds. The other parts are because of the bad news in China and then flight capital out of emerging markets in China, in my opinion. So the bad news in China, the bad economic data in China, the stuff going on in Hong Kong, the bad German exporting numbers, that is what is driving more capital out because people are fearing recession, that the global economy is slowing down a lot. So people then, at least historically, a lot of professional money managers are not my age. They're not in their mid to late 30s. They're a lot older. So they've been around, and they're going to go to what they know best. They're going to go back to saying, I'm going to retreat into the dollar. I'm going to retreat into US Treasuries. So I think that is playing a large part, that a lot of these professional money managers who have been in past recessions, they're doing what they did in the past. So I think the China story, the stuff going on in China with the data, the stuff going on in Hong Kong, is driving money out of the stock market for now and money into bonds. And same thing with emerging markets. Look, when commodity prices go bad, when commodity prices are not looking good, especially in oil and base metals, and we see bad numbers from China, that's going to spook a lot of commodity investors, and that's going to spook a lot of emerging market investors. I only have 15 upvotes. There's over 100 people watching. I should have more. So yeah, the yield curve will eventually, a recession will happen. But you have Alan Greenspan out here and Janet Yellen out here providing spin. I wonder if they were paid to do it or maybe they were just asked. But Lael Brainerd said, remember, you got to go back, because I think she was one of the few honest people, or at least for certain parts of her speeches. And she said this, I think, in February of this year. Because remember, she was trying to get a job promotion. She thought she was going to get a promotion. So she was trying to be on the record with having good predictions. And she said straight up, the Federal Reserve does not care if they invert the yield curve. They don't care. Doesn't matter. And this all... Whoop, sorry, I tapped my microphone there while I was waving my hands. I should not do hand gestures while I am doing a podcast. No one's going to see my hand gestures. Anyways, so this all goes back... I'm moving my hands again. So this all goes back to financial repression. This all goes back to Japanification. Okay? This benefits driving the yields down. This is good for the U.S. government. Okay? In the long run, this is great. The U.S. government now, and the Treasury's going to have to issue a shitload of new Treasury soon. And they're, move my hands. You can't see my hands, so it doesn't matter. The Treasury is going to have to issue a lot of new bonds soon. So the lower these yields go, if I was running the U.S. Treasury, and first of all, I'm glad I'm not running the U.S. Treasury, but if I was running the U.S. Treasury now, if I was in Steve Mnuchin's shoes, I would, over the next couple days, be like, hell yeah, we're going to do a large Treasury auction. We're going to sell as many 30-year U.S. Treasuries now at the lowest yield in history as we possibly can. So the lower these yields go, the more it benefits these over-indebted, spendthrift, drastically wasteful governments. And like I've been saying now for a while, China's trapped. The European Union's trapped. Japan has been trapped for a long time. And the US is trapped. So on a relative basis, these professional money managers and these people that were invested in energy and base metals and professional money managers and also emerging market stock investors, they're going to say on a relative basis, the U.S. still looks the safest, at least for the short term. And that's why you are having more and more capital, flight capital, coming back to the U.S. in the bond market and not into stocks, at least for now. And speaking of the stock market has given back all the gains the stock market had done nothing, according to Jeff Gunlock, and I looked at the charts since January of 2018, but now it's even below January of 2018. So the stock market, the rallies are not nearly as strong. It has made lower highs on the rallies. And the real economy has been screaming that in the U.S., the real economy in the U.S. and the global economy, but the real economy in the U.S. with the retail reporting A lot of these retail store, all the store closings, all the retail numbers. I just saw a story today. There was a survey, CNBC ran it, from Bankrate, and it said a large chunk of Americans can't afford a vacation this year. So please tell me then, with all these store closings and how Americans can't afford a vacation, how this is the greatest economy ever. It doesn't add up. Okay, it's just all rhetoric. All these people have to stop the bullshit. But you know what? Bullshit sells. Bullshit buys votes. It's all about the short term. Telling people the truth is a dangerous game. Look what happened to that poor Chinese mainland economist. Best case scenario is he disappeared for 3 months and was probably tortured and brainwashed for at least a few months. And maybe he's safe. I don't know. I haven't gotten an update on him. Zero Hedge is not covering an update on him. They covered the article that came out when his video went viral on social media about how China's real GDP was 1.67% and contracting violently last year. So these governments, whether it's China, the US, Japan, European Union, they don't want the truth. Actually, I would say most people don't want the truth. But especially the governments don't want the truth. Fitness and finance. Dumb to short the S&P. I would be careful because President Trump is on Twitter demanding the Federal Reserve steps in. I have the article about the Chinese economics professors in the live stream I did a couple hours ago. But President Trump is tweeting now, earlier today at least, calling out the Federal Reserve, wanting more rate cuts. So if you short, this is not financial advice, just my opinion. If you short the S&P 500, the regular stock market, right? What's to say that the Federal Reserve cannot do emergency rate cuts to try to move the stock market higher? Do I see a pullback in gold? Or is it heading up in the foreseeable future? Well, first, let me just continue my point here on the stock market. So the stock market could crash, or have a big correction, but it would only be for a short period of time, maybe at most, my educated guess, at most 12 months. There is way too much in capital gains tax revenues. If you go to the St. Louis Federal Reserve website and you look up the capital gains tax revenues of how much in capital gains taxes the US Treasury lost during 2008 when the stock market crashed, the Treasury lost about $1 trillion in annual tax revenues. So when the stock market crashed in 2008 and the real estate markets crashed and the bond markets, some of them had problems. Now, obviously, I think Treasuries did well then. And I think the dollar did pretty decently, at least for a certain part of 2008 and 9. But at least before quantitative easing programs were announced. But I don't know if the Treasury is willing to risk their annual budget, their tax revenues being cut in half. They would they have around $2 trillion in annual tax revenues now. And if the stock market crashed and the Federal Reserve didn't intervene, they would risk losing maybe half. And that would just blow a hole in the federal budget, and that would mean that the Treasury would have to sell more treasuries because they would be running even larger deficits because they wouldn't have the tax revenues to cover, and that would mean the Federal Reserve would probably have to, whatever they plan to do on the size of the QE program, they would probably even have to do it larger. So I've been saying for a while that if there is a stock market crash, it will probably only last for at most like 6 to 12 months, educated guess, somewhere in that time frame, before the rules are changed and more quantitative easing or rate cuts or some other scheme is done. Hey Felix, I'm glad you like the channel. Thanks for the super chat tip, Blue Steel. So back to gold. I got a little off tangent there. I don't worry about the short term in gold. There are people who do. I don't really care. If you don't have a good gold position, then you wait for dips and you buy. This is not financial advice, but if you don't think you have enough physical gold or physical silver for savings, insurance, wealth preservation, and if you don't think you have enough exposure to the best gold stocks, then hypothetically, I would want to be adding on dips. I would not want to be chasing prices higher. Because we know that the people in power do want to try to smash the gold price. They don't want the gold price going up like $50 per day. So there will be opportunities to add to your positions on corrections. There should be some corrections. I don't know about big corrections, but that's why you never buy. The mistake most people make, especially retail investors, and this is from talking to a lot of people in the last decade, is that a lot of people, do research or they read a story about a stock and then or a couple stocks, and then they stupidly buy all of their stock position all at once. Instead of breaking it up into thirds, planning, say, this is hypothetically, say you have $20,000 of a $100,000 portfolio and you're going to put $20,000 into one stock. Okay, you're going to buy a big chunk of stock because you've done your research and you like the company. Well, you would not buy all $20,000 worth of stock at once, would you? That would not be smart. So you would buy it in chunks. Maybe you'd buy it in fourths or thirds. So you'd buy a third now. You would have a position. So if the stock went up, okay, that share, I don't own all the shares I wanted to buy, but I have some. And I'm going to do well in those shares. If the stock price went down, most people don't do this. And this is why a lot of people don't succeed buying individual stocks. Number one, they listen to bad research, or number two, they get stolen on fees from mutual funds. But a lot of people also, they do research on a stock and they stupidly buy. Okay, I'm going to leave this off because someone will get pissed if I say this. It's like a juvenile teenage humor joke I was going to make there. But they stupidly buy all of their stock position at once. So if you plan on buying a certain amount of dollars worth of a certain stock, do not buy the entire position at once. Probably don't even buy half the position at once. You buy it in thirds or quarters. And then if the stock goes down 10% or 20%, you buy more. Or maybe you buy a lot more. Or if you're more daring, you can split it up into halves. You buy half of it then, so you have a position, and then if it goes a lot lower, you can maybe buy more than you planned. Again, this is not financial advice, but most people do not understand how to build a stock position at all. Oh, I tell my joke. I was just going to say that people like blow their load and they buy all of their share position all at once. Which is not how you succeed at all. Sometimes you get lucky. You may get lucky, but then your process is bad. Your investing process of how you build a stock position, of how you average up or average down into a position is bad. I'm not trying to be stand-up. I'm not really sure. I may have seen that out of context. I don't think there will be a big dip for gold. It looks like a lot of capital is going into gold. And surprisingly, it looks like China may have just limited their gold imports for private citizens. That was a little weird to see that story today. Most governments run on propaganda and pretending. It's like that throughout history. A $20 move in gold is not big. Like $50 per day. If the gold price moves $50 per day, I would view that as big red flags that the global economy is close to collapsing. That there's stuff behind the scenes with the bank. That there's some crazy stuff with HSBC Bank. Last night, one of the podcast listeners here sent me an article about how this subsidiary company that HSBC bought, the CEO of HFC Bank, he just killed himself because he was going to go to prison. He was selling in like the United Kingdom and elsewhere. He was selling really bad predatory subprime loans and other stuff. So he was being investigated and he was probably going to go to prison, and he just killed himself. I think that was last week, but I just got the story yesterday. So all that stuff's connected to HSBC Bank too. There's a lot of red flags at HSBC now. I don't know what's going to happen. There's two competing theories. We'll see. Both of them may happen with HSBC. The Chinese government may want to drop the hammer on them, and HSBC may have tried to be greedy and borrowed a lot of money, and lent a lot of money to the People's Bank of China for dollars so that they could prop up the RMB. And then the Bank of England found out, and the Bank of England told HSBC, you're not getting a bailout. And then the CEO of HSBC got fired, and a bunch of other crazy stuff. Yep, 3 executives were fired from what it sounds like in barely a week. Even though the press releases from the bank, which I don't believe, say that the retirements were planned. For 2 of them, at least. I explained why the stock market is not doing well today. I think there's a lot of bad data from the global economy, especially from China. And then there was bad export data from Germany. And then people are worried about those 2 things, along with the stuff the videos that are going around Hong Kong. It's very serious. No, the stuff in Philly was actually a police sting operation. There was a it was an undercover, I think, police sting operation for a drug dealer. And then somehow I think the drug dealer found out that they were undercover cops, and now he has hostages. At least that's what I just heard before I started this live stream. Steve, I've talked about this with Deutsche Bank before I let you guys go and just wrap up this short video. Thank you for the $10 super chat, Christopher Quinn. I appreciate it. Before I wrap up the super chat, I've explained that my theory about Deutsche Bank is that the central banks, so the European Central Bank and or Federal Reserve with currency swaps, could let the equity, the share price of Deutsche Bank go to 0 while they tell everyone that they're guaranteeing at part or all of the derivatives with currency swaps. So the shareholders of Deutsche Bank would get wiped and the derivatives would be guaranteed, at least in part. That would be my educated guess. So we'll have to monitor this. The research, I'll attach these 2 articles about the inverted yield curve, but the research I saw that I spent a lot of time on in April and May, was saying it takes 18 to 34 months of lag time. Now, if you started the clock since April and May, we've already eaten into a lot of that. But it says that the inverted, on the other research I just saw with the articles that I skimmed through before I started this live stream show, it says that the inverted yield curve could start to cause a recession in as soon as 8 months. But this all goes back to financial repression and Japanification, that these governments cannot pay higher interest rates on debt, especially the European Union, especially Japan, especially the United States. And so it's an incentive program for them to steal income from their citizens, from savers and bond investors and retirees, so the government does not have to cut back in size and scope and amount of government spending. Okay, guys, well, I'm going to go relax. I've done 2 live streams for y'all, and I have an interview tomorrow planned for Art Berman, the oil expert. So I think that'll be a good one. I haven't interviewed him in a couple years, but I always enjoy hearing from him. I think he's a brilliant analysis. He's been in the oil industry for decades, and I think he lives around Houston. So he has a lot of good contacts down there, and he was an early investor into a lot of these shale wells. He did get a positive return on a lot of them, and I think he's been warning people about a lot of the dangers of shale oil now, the problems with the economics of it. Okay, bye for now.